Take a look at this. The 10-year Treasury yield spiking above 193. That is the highest level since December 2019. The move coming on the back of a better than expected jobs report. The U.S. economy adding 467,000 new jobs in January. And that kind of growth could prompt the Fed to be more aggressive. So thinks the market. The market now pricing in 6 rate hikes through next February. But check out the reaction in the market today. Tech stocks rallied, the Nasdaq gaining 1.5%. Amazon, a big driver, of course, adding more than 13% on the back of its quarterly results. We're now halfway through earnings season. We've heard from all the tech titans, and given today's action where yields and tech actually rallied together, is this market signaling that it has made peace with Fed tightening and that the worst of the volatility is behind us? Pete, what do you say?
Boy, that's a tough question, Mel. I mean, it really is, because we're just starting into this earnings season and we're already looking ahead. But I will say this, when you look at the majors in terms of who's reported so far from the tech industry, we've heard pretty much great earnings from the mega cap names. You look at Microsoft, that was outstanding. You look at Apple, I thought that was great. I thought Amazon's today were fantastic. Obviously, Meta, not so much. I think they've lost their focus, and I think that's really part of what we are seeing as far as the technology front. But it looks like people are willing to dip their toe back in once again, at least for now. We'll see how long that lasts. We know there's volatility. We know that we have incredible volumes in the market, traded another 47 million contracts in the options world today. So I think there are a lot of positives right now, Mel, and obviously with that jobs report, that did give a little bit of a spike to a lot of different areas, not just technology, but take a look at the financials today, having a great day as well. So up well over 1%. So I think that there's a lot to read through right now. There's still a long way to go. We're just kicking off earnings season. But at least early on, I think I'm pretty impressed so far with what's happened with most of the majors in terms of the technology space.
We focus on technology and high yields because they don't usually, or they haven't, at least lately, moved together. And if you take a look at the bounce that we saw in tech stocks, it wasn't just the big cap tech stocks. It wasn't just Amazon. In fact, if you take a look at the work from home ETF, for instance, just as a barometer of sort of the riskier parts of the market, the higher valuation pockets of the market, that was up more than 2%. IGV software index, higher valuation parts of the tech sector, up by more than 3%. Bonawyn, is this a good sign that these things could actually move higher along with higher rates?
I'm always hesitant. Again, great question, Mel. I'm always hesitant to take one data point and try to extrapolate some type of trend there. But I will say, I do think, and I mentioned it a bit earlier, some of the other panelists as well, that I do think this does give us a little bit of insight into risk appetite and willingness to take on more speculative pockets of the market. Now, I don't think that you can just isolate that move in the 10-year. The 2-10 yield still needs to kind of participate, and we're still seeing downward pressure there. As far as the 10-year moving higher, I do think it does show that the market is at least digesting this information and interpreting it to mean that we are looking for more robust growth. And the jobs data kind of like proves that point as well. So I think that that does kind of give, some floor. But you got to keep it in context. A lot of these names, even some of the large caps, are off, and they're just now starting to get back to previous watermarks. I think Carter would have an absolute conniption if we were celebrating lower highs as now a reversal of trend. So I do think the volatility continues to be a major part of the market. I think that you are seeing people willing to kind of dip their toes in, but keep in context that we have come off significantly, and you're seeing some disbursement or some parsing between those that have been able to meet and exceed on both top and bottom line and guidance, and those that have not been able to.
I think the question, given the pullback we've seen, Nadine, and now with the seeming stability, at least for now, is that perhaps we pulled back enough and that valuations are more fair in this market, and that it is time, as Bonawyn had mentioned, to perhaps build some positions or dip your toe back in, so to speak, on some of these names. I mean, today, Steve Leisman had this chart out, which was just mind-blowing to me. 6 rate hikes are being priced in from now through February 2023 with greater than a 50% chance. So it goes 100% for the first 2, and then it goes to above 50 for the next 4. And we haven't seen that for the market to be, pretty much okay with that.
Well, Mel, I'd fade that move. So, the upcoming slowdown in reported growth was never going to be coming from the hiring side. Instead, it's going to come from lower spending. Remember, just go back a couple weeks ago, there were some pretty bad retail prints. And the economy is going to be shifting for one driven by reopening and stimulus payments to one running on current income, which is falling. And of late, the choppy market performance. So companies pocketed extra cash from higher prices and lower supply levels. I don't think they're going to expect demand to sustain in many areas of the market. So it's ex-tech, at least for goods, at these exceptional levels. So I'd be buying long-term treasuries like the TLT today, going into staples and utilities, because everybody's on this side of the mood short these things like staples and utilities and treasuries now. So I'd actually fade that because there's no way they're going to raise rates 6 times unless it's at a much smaller level because growth is slowing. And so I just think maybe you get 1 or 2 hikes in, kind of like I think Bonawyn said. But other than that, you want to take the opposite side of that trade.
Steve, what are you thinking about the markets these days?
Yeah, so I do think that I'll take the under like Nadine and Bonawyn as far as the rate hikes. Bank of America was that outlier where he thought it was going to be 7 price hikes. But they never talked about what are you going to do with asset purchases? Oh, we're going to stop those. And then what's the other side of it? We're going to liquidate the balance sheet or let the balance sheet run off. Those are equivalent to rate hikes as well. So is it 7 in a vacuum or 7 plus those? Because there's no way that's going to happen. Now, if you look at the earnings that we've seen in the tech sector, I don't think that the market is saying they're okay with higher rates. What happened? Now, Google, fabulous print. What happens if they don't announce a stock split? Amazon, good print. What happens if they don't have that Rivian income there, or if there's not a speculation that there's going to be a stock split there, or if they don't have a price hike there? So there's definitely individual stock stories that are rallying the market. It is not over yet. Just look at Meta, how you open the show. Meta hasn't caught a bounce. It's on day 2. Day 3 is on Monday. So when you start to look at where the rates are, Bonawyn, I believe, said this. The 10-year was a result of the market thinking we were going into recession. The market now is thinking, okay, maybe growth will be okay. The front end, though, has to come in. And the only way that comes in is if Chairman Powell takes his foot off the rhetoric, and then you get that steepening of the yield curve. Value starts to outperform. I think you probably sell tech into this move that we've seen, and we probably haven't seen the lows in the market yet.